Hi, welcome back. In this section, we are going to cover the most important topic in all of finance, the time value of money. So, what are we going to do? Well, first, I'm going to introduce the concept of the time value of money, and then we're going to talk about why it's so important in valuation, and then finally, we'll talk about why compounding is so relevant in the field of finance and how it relates to the time value of money. All right, so what is the time value of money? The time value of money is the basic principle that states that a dollar today is worth more than a dollar tomorrow. And there's a couple of reasons for this that we'll talk about, but just to capture it in a nutshell, the reason we say that a dollar today is worth more than a dollar tomorrow is because today's dollar is guaranteed. It's already in hand. It's the concept of a bird in the hand is worth two in the bush. So today's dollar is guaranteed, but tomorrow's dollar might not be guaranteed. So the reason we focus so much on the time value of money is because, well, if you're waiting on a dollar tomorrow, there's some uncertainty there. There's some risk there. And in order to be willing to give up that dollar in your hand today, you need to obviously demand some additional compensation in order to wait for another day or another year to receive future compensation. All right, so this is our basic time value of money formula. We'll talk about it all day today, but I will say that if you do not memorize this formula immediately, I can guarantee you every finance class you will ever have, you will fail, because this is the most important, most fundamental formula, and it underlies everything that we do in our field. All right, so let's talk about the components. Now, there's really four components to the basic time value of money formula. The first is the PV, or present value. This is your value today, the amount that you initially invest, or the amount that you invested a certain time ago in order to accumulate a certain amount of money today. Basically, it's your initial dollar value. Next, we have our FV, or future value. This is the amount you have after investing for a certain amount of time. So, for example, you put $100 in the stock market. You invested in, let's say, 10 shares of Ford Motor Company. After 5 years, you have $150. That $150 would obviously be your future value. The last two components are our return and our time factor. Those are a little, we'll talk about those in detail, and we'll have different terms for both of those throughout this course, but let's focus on the return first. So our return, that's just your percentage return over every period during the lifetime of your investment. So we'll have a huge number of names for these, for this variable. I'll introduce you to as many as I can here in a few minutes. But suffice it to say, our R in this time value of money equation, this is our return, and you can think of it as the percentage that you earn on your present value every single period that you're investing for. Our T is just the number of time periods that we're investing for. So if you're investing in the stock market for 10 years and you have an annual return of 10%, your T is going to be 10 years, obviously. One of the most important concepts in finance when you use the time value of money is that your T, the number that you're using, should match up to the period over which you're estimating the return. So if you're using an annual return, you need to denote the number of years as your T variable. I will say that when we get into using the calculator, and if we do touch on Excel, this T variable is often referred to, or is that it's often used and recorded by financial professionals as N, so indicating number of periods, or I mean, essentially T and N are synonymous in our field. All right, so let's take a look at an example to illustrate why the time value of money is so important. So let's say you have a friend that wants you to invest $1,000 in his restaurant. Now, if your friend is asking you to invest, you should realize that there's obviously some risks associated with that investment. There's all kinds of widely reported statistics. I think there's one that I've heard several times where 80% of all new restaurants fail within the first 5 years. So the reason we care about those statistics is because if there's risk in that investment, you might lose your principal. You might lose that present value that you're putting in today. So there's a reason why you might want some additional compensation for investing today. Obviously, if you invest today, you would not have that $1,000 to buy something else with. You might not be able to buy, let's say, make a loan payment on your car. You might not be able to buy a new laptop. You might not be able to go to the Pink Floyd concert that's in Indianapolis, although most of the people I'm sure watching this video are a little young for Pink Floyd. Okay, I feel old now. All right, second reason you might want some additional compensation for investing is because you might have other investment opportunities. So we'll talk about this throughout the course, but if you know that you can invest in an asset, you can, let's say, buy a bond that offers you a 7% return, and your friend's restaurant is likely only going to yield a 5% return for similar risk, unless you have some altruistic means or reason for investing in his restaurant, you'd be a fool to invest in it. So you have to understand when you're using the time value of money, the reason we have a return and the reason the time value of money exists is because there are other investment opportunities. And so the reason this is important is if you are investing in an asset, that return that you would be earning, it needs to be comparable to other assets that offer a similar, that would lead you to face a similar level of risk. And we'll talk about the type of risk that is associated with returns later in this course. All right, the last reason you would want some compensation for investing is obviously because the restaurant is extremely risky. I suppose 2 and 3 are very, very similar. So the riskier the investment, chances are the higher the return you would want. In other words, the greater the compensation you would want for investing in that restaurant. So if it was very likely that that restaurant would fail, you might demand a return well above what you could get in the stock market. All right, now, when we talk about the time value of money, we need to mention a very universal fact in the field of finance, and that is that in most cases we assume that where there's greater risk, we demand greater return. In other words, in order to convince investors to invest in a particular asset, a lot of times the issuer of that asset, let's say the company issuing that stock or the company issuing that bond, that issuing body will often have to provide additional incentive through a higher expected return in order to compensate investors for the additional risk associated with that asset. Now, I thought it would be a good idea to show you some historical data on the returns or the interest rates of some very popular assets in the U.S. economy, just to illustrate this point. So, for example, the yield or the interest rate on a 10-year U.S. government-issued Treasury bond is currently 2.63%. I will say, we will talk about this later in the course, but this asset, the 10-year T-bond, this is often referred to as our risk-free asset, our risk-free rate. Why? Because the U.S. federal government that issues these bonds has never defaulted on them. If you buy this bond, it is almost universally assumed that you are going to receive this compensation, this return, this interest rate when you purchase this bond. The next asset we have is Apple's 10-year bond, and that yields an interest rate of 3.19%. Now, obviously, you can see that even though these two assets, the 10-year T-bond and the 10-year bond issued by Apple, even though the maturities are the same, 10 years, the bond issued by Apple has a higher interest rate. It offers a higher return to investors. Why? Well, it's because Apple's bonds are not free from default risk. Apple as a company could, let's say, default on its debt obligations. Let's say the company ran out of cash and it can't meet its coupon payments to its bondholders. In that case, you as a bondholder would not get paid, or you might get paid a fraction of what you're actually owed based on what's in the bond indenture agreement. And so this is why we see this difference in the interest rates between these two assets. In other words, the 10-year T-bond, it comes with less risk, and so the issuing body, the U.S. federal government, can offer a lower interest rate to individuals or investors who want to buy this asset. Whereas this Apple bond, there's more risk of default associated with this bond, and so it carries a higher interest rate or return. Now, to put those in perspective, I pulled some data on the average stock return from 1926 to 2015, so over about a 90-year period. And over that period, our average return annually is about 8.1%. The reason we see this massive difference between the bond returns that I've already provided you and the average stock return annually is because stocks are a lot more volatile in terms of their prices than bonds. In other words, you might see in certain years the average price of a stock on the market. Let's say we'll use the S&P 500 index as our gauge. So you might see the S&P 500 index fall by 20% or 30% or even as much as 40% in a year, indicating that the value of the assets in that index have fallen by about 20, 30, or 40%. So what I'm trying to convey here is that your returns on a particular stock are much more volatile than they would be for a bond. So in other words, there's more risk here, and therefore investors that invest in the stock market typically demand a higher return on their investment. And this is actually what we see historically. In other words, companies initially price their stocks in order to offer a higher return in the future to investors that buy shares of their stock. All right, so I thought it'd be a good idea as well to show you what happens when we have different interest rates or different returns. What happens to an investment with a different level of return. So what I have here on our slide is the future value of an asset that has a present value of $1,000 but has a different level of return. So the top line there, the green line, that indicates a 15% annual return for that asset. So over 10 years, that asset has appreciated in value from about $1,000 to a little over $4,000. Compare that to the red line, which indicates that the asset in question appreciated in value from year 0 to year 10. It looks like it went from about $1,000 in terms of present value to something like $1,200 maybe in terms of future value. So our return certainly matters when we're determining which asset to invest in. The higher the return, the larger the future value. That should be fairly straightforward. All right, a couple final points on present values and future values. So I guess I've touched on everything I want to go through in terms of future values, but present values, going forward, perhaps in this chapter and certainly after this chapter, you're going to hear me referred to the present value as the principal, or sometimes I might call it the initial investment. Both of these are obviously synonymous with the present value of an asset. When we get to bond amortization at the end of this chapter, I suppose I will certainly use the term principal to denote the amount that has been invested or the amount outstanding that you have in terms of your loan. So I will use those terms synonymously with present value. Okay. Now, in terms of return and time, I mentioned this briefly, but I want to reiterate it just because it inevitably catches students off guard the first time they try to calculate, let's say, the future value or the present value of an asset. And the thing I want to convey here is that our time variable and our return variable, they always have to have the same periodicity. Doesn't matter. So our time variable, this could indicate years, months, days, quarters of a year, whatever it is. We need to make sure that our time variable denotes the same period of time over which we're measuring our return. So, for example, if we have an annual return, then we want to make sure that our time variable denotes the number of years. If we have a monthly return, then we want to make sure that our t is equal to the number of months that we're investing for. So that's very important, and I guarantee you're going to make that mistake at least once in this class. So I just thought I'd warn you ahead of time. Watch out for that. All right. One final point I want to make with regard to the return, and that is that throughout this course and in the field of finance in general, we have a huge number of terms to refer to a return that we use to refer to a return. So for example, when we get to bonds, we might refer to the return on a bond investment as the yield or the interest rate. When we start talking about how to value a company, we might refer to something called the discount rate or the cost of capital or even the weighted average cost of capital. All of these are fairly synonymous with the return, and we're going to use them in our time value of money formula, but I wanted to provide you a full list just ahead of time so that you know, or that you've actually seen all of these terms, and you should have some sense that they are or they can be used in that time value of money formula. So if I start referring to an interest rate and plug it into the time value of money formula, I don't want you to freak out too much. It's just something that we normally do. So regardless, I'll do my best to make sure that whenever we use a return or an interest rate, I'm going to use the variable r. So just so we have some consistency there. The field of finance, I will say, it's unfortunately we haven't nailed down our variable letters. I mean, time can be denoted t or n. Return or interest rate can sometimes be denoted as I or R, but like I said, I'm going to be denoting return or interest rate as R, and I'm going to try and do that consistently. But just I thought I'd front run this and make sure that you were aware of it. All right, so that's that.